Good morning and welcome to Fiscal Pulse Media. I want to start this morning with a story out of Albuquerque, New Mexico that dropped about 2 weeks ago because it's the perfect setup for everything we're going to talk about today. Presbyterian Healthcare Services, 118 years old, $6.8 billion in revenue, the largest health system in New Mexico, just announced they are walking away from most of their Medicare Advantage plans. Effective end of 2026, 30,000 members need to find new coverage. And over that time, 150 jobs will be eliminated. A system that built its identity around being both the insurer and the care provider just decided we can only afford to be one of those things, and they chose the care provider. Their CEO put it this way: staying in the Medicare Advantage market would limit Presbyterian's ability to invest in care, workforce, and access for the natives of New Mexico. I want to translate that for you. Quite simply, what he is saying is the math stopped mathin'. The math isn't working anymore. The Medicare Advantage reimbursement environment has deteriorated. CMS rate updates haven't kept pace with medical cost trends, and when you have a health system trying to run a health plan on the side, that deterioration hits you in a very specific place. It hits the reserve. Presbyterian is not in financial trouble. They're rated very healthy by those agencies that do that. This is not a crisis. This is a strategic exit from a product line where the economics have become untenable. And they're not going to be the last system to make this call, nor the first. In our last 2 weeks' episodes, we talked about Pacific Source, located right here in Lane County, Oregon, how they've pulled out of Montana, they pulled out of Washington, and now they're pulling out of the Medicaid plan in Oregon and Lane County. And then last week we talked about Providence Health Plans, a large player in Oregon, and they are discontinuing all of their health insurance at the end of this year. 431,000 members in the state of Oregon are going to have to find new insurance at the end of the year. Now, here's what I want you to hold on to as we go through today's episode. Presbyterian decided to exit. 30 years ago, the organization I helped run, LIPA, Lane Individual Practice Association, a physician-led Medicaid health plan right here in Lane County, Oregon, faced a version of the same question. And we made the opposite decision. We stepped into full financial risk. We kept running the plan, and what followed was not symbolic. It was operational. That is what today's episode is about. I'm David Cole. I spent 18 years as the CFO of that physician-led Medicaid health plan in Lane County, Oregon. Every Tuesday at 8:30 a.m. Pacific Time, I come here to talk about what's actually happening in healthcare finance, not the version that ends up in the press release. Article 4 of my series, it's on Substack, is called When Responsibility Became Operational. I'll put a link at the end of the show. It is the story of what happened the morning after we agreed to carry the risk, when the theory met the balance sheet, and when a physician organization had to build financial infrastructure it had never needed before. Let's get into it. First, a little context for anyone who is new here. The Oregon Health Plan launched in the early 1990s. It was Oregon's expansion of Medicaid, one of the most ambitious state-level healthcare experiments in the country. And it was built on a premise that sounds simple, but is actually radical. Instead of the state paying fee-for-service for every medical claim, the state would pay a fixed monthly amount, a capitation rate, to local health plans, and those health plans would be responsible for managing the care of an enrolled Medicaid population within that fixed budget. The state secured budget predictability. The financial uncertainty, though, moved to the local delivery system. For LIPA, that transition happened in stages. In the beginning, we were coordinating care under someone else's balance sheet. There was a layer of insurance coverage between us and the full financial exposure. When that layer was removed, When we assume full financial responsibility, the nature of our work changed completely. Coordinating care requires communication, referral management, and clinical judgment. Managing financial risk requires something different. It requires forecasting. It requires reserves. It requires actuarial awareness and governance discipline. Those are not the same skill set, and the organization that is good at one is not automatically good at the other. That is the gap that Presbyterian just decided they could no longer bridge. And that is the gap that LIPA had to close, and fast, when we took over that contract. The first thing that changes when you take on a full financial risk contract is your relationship with uncertainty. In a traditional fee-for-service world, a claim comes in, you pay it, you record it, you move on. The liability is visible, you know what you owe. In a risk-bearing organization, it is not that clean. Hospital claims surface weeks or months after services are delivered. Specialty billing cycles vary by practice, by payer, by specialty. Pharmacy costs fluctuate before trend lines stabilize. What this means in practical terms is at any given moment, there are medical expenses that have already been incurred, services already delivered to your members that have not yet been submitted to you and have not yet been processed. In insurance terms, we call this IBNR, incurred but not reported. IBNR, incurred but not reported. I want to be direct about what that means because it sounds like an accounting term, and it's actually something more dangerous than that. IBNR is not technical trivia. IBNR is exposure. Every month, you are sitting on a liability you cannot fully see yet. And you have to estimate it. You have to make assumptions about utilization, about seasonal fluctuations, about billing lags, about whether there's a catastrophic case out there that hasn't surfaced in your system yet. Underestimate it, and when those claims arrive, your reserves are thin. You are surprised. And in a regulated insurance environment, being surprised by your own liabilities is not a small problem. Overestimate the liability, and you have constrained your operational flexibility. You're holding cash you may not need when that cash could be doing something else. At the stage we're talking about in the LIPA story, the mid-1990s, reserve expectations were often framed as a percentage of revenue rather than fully developed actuarial models. The discipline was still evolving across the industry, but the underlying reality was not negotiable. Regardless of how sophisticated the methodology was, if your reserves were inadequate, volatility would not forgive your optimism. Managing full financial risk meant developing fluency in uncertainty, not eliminating it, not pretending it doesn't exist. Fluency, the ability to look at what you can't fully see and make a defensible estimate of what's there. That's a skill, and it took time to build. IBNR is ordinary volatility. Month to month, noise in the claims pattern, but there is another category of exposure that sits on top of that, and it is the one that can genuinely threaten an organization's survival. A single catastrophic case. Early in my career at LIPA, we had the mother of all cases. We had a very sick baby, newborn baby, who was put into the neonatal ICU department at the hospital as soon as they were born. That baby then spent 6 months in that unit. If we were a commercial carrier or if we were paying just cash for that service, it would have been a $2 million bill, over a $2 million bill. Because we were a Medicaid plan, we had negotiated rates with the hospital that were quite a bit more advantageous, and because it's Medicaid, the hospital was willing to accept less. But the claim still was about $1 million. At that point in my career, LIPA had a gross revenue of around $50 to $60 million a year. It wasn't that big yet. You have a $1 million claim, that's truly catastrophic. A single catastrophic case. It can be this like this case I'm talking about with a very unhealthy baby. It can be a transplant. It can be cancer diagnosis that requires aggressive treatment across multiple specialties. A trauma case with a long ICU stay. These cases are rare, but when they hit hard. And in a fixed funding environment where your monthly revenue is capped by the capitation rate, a single catastrophic case can overwhelm an entire year's projection. Now, at that time, when this baby was born, we had reinsurance with a company, and we had negotiated where anything over $40,000, they would take that risk. So that's how small of an organization we were as a health plan. We really could not pay claims that exceeded $40,000. And so instead of having to pay that $1 million claim, we paid $40,000. There would be some things that weren't covered. I think we ended up paying about $82,000. But an $82,000, and then the reinsurance paid the rest of the bill. An $82,000 hit to our bottom line, although not great, it was not catastrophic. It was something that we could handle. So you purchase protection from a reinsurer that kicks in above a defined cost threshold. And in this instance, $40,000. You pay a premium. In exchange, costs above that attachment point get absorbed by someone else. I remember thinking during the time when this unfortunate situation happened, and the good news is the baby lived and went and was able to proceed with their life. We don't follow the history, but at least for the next 2 or 3 years, we were able to see that the baby was alive and doing well. But I remember at the time, as the CFO of this company, thinking, okay, what happens if the reinsurer comes back and says they're not paying? What happens if only certain things are covered by the reinsurer? It was a very testing time in my career, because this could completely sabotage our company. And you say, well, why would that happen? Well, that was the nature of the beast at that time. And we're talking about Presbyterian Health closing. They're a $1.8 billion, or what, a $6.8 billion company. We at that point had reserves of probably about $1 to $1.5 million. So we are still a very small company. For LIPA, a physician-led organization that had been built around coordinating care, not insuring it, reinsurance was new terrain. Reinsurance negotiations require modeling attachment points. They require evaluating premium trade-offs. They require balancing protection against costs. Too little coverage, and you're exposed to a catastrophic case that wipes out your reserve. Too much coverage, and you've consumed margin, paying premiums for protection you don't need. It's a calibration, and it requires the same actuarial fluency we just talked about. The ability to look at your population, understand your risk profile, and make defensible assumptions about the tail risk you're carrying. Full financial risk did not eliminate risk. It redistributed it and layered it. The organization was no longer coordinating care under someone else's balance sheet. We were building our own, deliberately, with intention. Financial responsibility expanded something else that I don't think gets talked about enough in the healthcare management literature. It expanded governance. LIPA assumed oversight of provider credentialing, verifying licenses, confirming training institutions, maintaining compliance documentation. What had once been a matter of individual professional standing became organizational accountability. Committees were formalized, not informal conversations between physicians, formal committees with minutes, documentation, and records preserved for state review. Coordination evolved into compliance. Risk had moved from concept to contract, and contracts require records. This was not a bureaucratic imposition. It was a logical consequence. When you are managing other people's health with public funding under a regulatory framework, informality is not a feature. It is a liability. Governance had to be systematic, not because a regulator demanded it on a particular Tuesday, but because the organization had taken on obligations that required it. And boards had to step up to meet those obligations. Directors could no longer show up, listen to a clinical update, and go home. They had to understand reserves. They had to understand exposures. They had to be able to ask the right questions when the CFO walked in with a projection they hadn't seen before. Governance literacy became a risk management tool. Here's something that took me a while to fully articulate, even though I lived it every day. Risk management does not live solely in spreadsheets. It lives in relationships. Under full financial risk, one of our constant operational pressures was maintaining a complete physician specialty panel. Cardiology, oncology, orthopedics, obstetrics. Under the Oregon Health Plan, access to those services was not optional. The coverage obligation was real. Specialists operate with higher cost structures. They know their leverage, and in the mid-1990s, some of them were not shy about using it. In a fixed funding environment, every contract adjustment is a trade-off. If specialty rates go up, margins come down. If a contract fractures and a specialist walks away, access deteriorates with it, and then your ability to meet your coverage obligations also deteriorates. Think about what that means in practice. A cardiologist decides our rates are too low. They terminate their contract. Now we have a gap in the specialty panel. Members who need cardiac care may have to go out of network. Out of network costs are higher. The fixed funding doesn't change. That cost comes directly out of the organization's reserve. Maintaining a unified specialty network was not incidental. It was a financial discipline. It required consistent negotiation. It required credibility within the medical community. And it required the kind of relationships that take years to build and can be damaged in a single, difficult conversation. This is the part of healthcare finance that the academic literature tends to underweight. The technical tools, IBNR estimation, reinsurance modeling, reserve methodology, those are necessary, but they are not sufficient. You also have to be the kind of organization that physicians want to stay associated with. Because if you lose that, the spreadsheet falls apart, no matter how good your actuarial model is. I want to close the content portion of today's episode with something that I think is the most important observation in this article, and the one that connects most directly to what Presbyterian is facing today. When you take on full financial risk inside a public program, there is a structural reality that never fully goes away. Responsibility expands. Authority does not expand at the same pace. LIPA did not control state funding levels. We did not control eligibility expansions. We did not control benefit design. We did not set regulatory requirements. If enrollment grew, the funding formula governed our revenue, not our preference. If benefits expanded, the coverage obligations followed, regardless of what it did to our cost structure. If compliance requirements changed, our administrative burden increased, without a corresponding increase in the capitation rate. Accountability rested locally. Structural design did not. This was not dysfunction. This was the structural reality of operating a local health plan inside a state-designed public program. The state needed local execution. Local execution meant local accountability. But the levers that determined the environment were held in Salem, not in Lane County. And this right here is what I think Presbyterian finally decided they could not sustain in Medicare Advantage. CMS sets the rates. CMS designs the benefit structure. CMS determines the risk adjustment methodology. Presbyterian, a local system operating inside a federally designed program, carries the accountability when the math doesn't work, without controlling the variables that drive the math. The model endured at LIPA not because this tension disappeared. It endured because the organization learned to manage it collectively. Boards understood volatility. Leadership understood reserve. The discipline became embedded. Without that literacy, responsibility becomes vulnerability. With it, a physician-led organization in Lane County managed Medicaid risk for more than 2 decades. It became Trillium Community Health Plan and was eventually acquired by one of the largest Medicaid managed care companies in the country. That is the story. That's Article 4 of the LIPA series, when responsibility became operational. If you're watching live, thank you for being here at 8:30 on a Tuesday morning. That means something to me. If you found this episode useful, if you're a CFO, a health plan executive, or someone who works inside these systems and recognize something in what we talked about today, I'd ask you to do one thing. Share it with someone who needs to hear it. A board member who doesn't fully understand reserves, a physician leader who just took on a new risk contract, a colleague who is watching what's happening in Medicare Advantage and trying to make sense of it. The full article is on Substack. As I said, the link will be in the comments. We have a new episode every Tuesday at 8:30 a.m. Pacific Time right here on X. I'm David Cole. This is Fiscal Pulse Media, the heartbeat of smart business. The heartbeat of smart business. We'll see you next Tuesday.